Okay, we are seeing business valuation. It's merger and acquisition. What's happening? Okay, so this where we started our discussion with Bolaji. Yes, I said the first question number 1, right? Yes, we're in this question. I don't think we have completed this question yet. We have not, right? Or have we? Hello?
We have not. We stopped at realizable value.
Okay, realizable value. Okay, so we stopped at this point. So let's get the other ones. Let us use the governance/dividend growth model to value this company. I believe we know what the dividend growth model is. Let me close all this icon I have here. Close them. Okay. So the governance growth model. The moment you hear governance growth model, 2 things will come into your mind. Number 1 is the fact that you are making a valuation using dividend. Okay? You are valuing the company using dividend. Number 2 is that the dividend you are using in your valuation is a dividend that is growing. So it's a growing dividend. So anytime you hear the governance growth model, automatically what it means is that dividend is growing. Dividend is growing. That's what it means. Now, trade dividend should be calculated. That's why I say God dividend growth. So your dividend should be calculated using Gordon. And I believe we can all remember the Gordon's growth model. Okay, let's see in case you have forgotten. Let's go through the questions. Sorry. Which one did I open again? That's not allowing this thing to close. Sorry, I want to. Okay, no problem. Look at the question and see how we are going to apply our Gordon's growth model. Now, if you look at this question, we are given history. You can see that.
So we
We are
can't see,
given dividend history.
we can't see the questions.
You can see what?
The question screen.
You can't see it.
I can see it now. If I was seeing the solution screen.
Okay, can you see it now?
No.
Okay, it will come on.
Okay,
Maybe
I can see it now.
Okay, good. Now, if you look at this question, we are given dividend history from 2011 to 2015. Look at the dividend. This is the dividend history of this company from 2011 till inception, which is 2015. Now, ordinarily, if the question does not specify what type of growth formula I should use, I may not use Gordon's growth model because there are two ways to calculate growth, and all the two can be applied to this question. Okay, all the two growth formula can be applied to this question. The first growth formula is what? The one you have at latest dividend over earliest dividend raised to power 1 over n minus 1. That is when you are given the dividend history. And of course, in this question, we have that dividend history, so we can use that formula. But because the question has specifically told me that I should use Gordon's growth model, then I won't use this approach. I will go ahead and use my Gordon. Now, how do we get our Gordon? The Gordon's growth rate is computed as G equals RB. G equals RB. And what is our R? Our R is return on equity. Return on equity. And I've explained that return on equity is what? Your profit after tax over equity plus reserve, opening balance of reserve. Okay? But that in a situation where you cannot calculate your return on equity, I said you can use your cost of equity instead, if cost of equity is given. And I've explained the difference between cost of equity and return on equity. That cost of equity is the return you are paying to equity holders on their invested fund. While return on equity is the return you are making on that equity. So if you subscribe to my company's equity now, the return my company is making on that equity is return on equity. And obviously, we are not going to give you all the return now. The one we are giving to you as a compensation for your invested fund is the return on equity. But the one the company is making is the one we are giving to you is the cost of equity. But the one the company is making is the return on equity. But in a situation where you cannot compute your return on equity and cost of equity is given in the question, you assume the cost of equity is the same thing as return on equity. In other words, all the return that the company makes is being paid to equity holders. That's what it means. Okay. Now, for us to compute this now, we have profit after tax, which is this. We have the reserve for the year, which is this. This reserve of 27,200, you know, is as at when? Is as at 30th June 2015. And what about our statement of financial position? The statement of financial position is also as at 30th June 2015. What's the implication of this? The implication is that this return on this retained earnings here, this retained earnings here is already included in this closing balance of earnings. Okay, this is already included in the open closing balance of retained earnings. So what do you need to do? You need to remove the retained earnings for the year from the total retained earnings you have in the statement of financial position, so that you get the opening balance of retained earnings. Do we understand this? So that's how we are going to get your return on equity. Then proportion of earnings retained, that is quite simple. Proportion of earnings retained is simply retained earnings for the year all over what? All over profit after tax times 100. That's how you get your proportion of earnings retained. So let us attempt to apply this to the question we have in front of us. So we want to use, is it Roman figure 4, I mean? Yeah, Roman figure 4. We want to use Gordon's growth model. We are using Gordon's growth model. Gordon's growth model. So because it's growing, we have a market value of equity to be equal to dividend into bracket 1 plus G close bracket all over cost of equity minus growth rate. Okay, over cost of equity minus growth rate. Now, where's our D0? Our D0 is going to be the dividend paid during the year, which is 25. Okay, we are not given number of, just pick the total dividend as your dividend for the year. So $25,000 G, which is equal to RB. R is return on equity. R is return on equity, which is profit after tax over equity plus opening balance of reserve. I'm not supposed to be giving you this formula again because it's a waste of time, but because I don't know whether you still remember it from what we discussed under cost of equity. So that's why I'm repeating it here. Normally, I'm not supposed to repeat it because of time. So what's our profit after tax? Our profit after tax is 52,500. 52,500. And our return earning for the year is 404,100. So, sorry, return earnings at the end of the year, rather, as at 30 June. So I put this one in the formula, 52,200. 52,200 over equity. Where's our equity? Sorry, I didn't pick that. Equity is equity is 454,100. Am I correct? No, that's not correct. Equity is 50,000. Okay, they even give us unit. Equity is 50,000 naira. Equity is 50,000 naira. So pick that. 50,000 naira plus 40,100, which is retained earnings at the end of the year, minus 20 what? Minus, excuse me, 27,200, yeah. 27,200. Minus 27,200. So return on equity will be equal to 52,200. Are we together, please? Over 50,000 plus. So what's the difference between this and this? Take away 27,200 from 4,100. What do we have? Let us be fast a little, please, because of time. Hello, Mrs. Chu, are you there?
Yes, sir.
Okay. So what do we have?
12,900.
12,900.
900.
So R will be equal to 52,200 over, add the two together, we have what? 62,900. 62,900. So what's our return on equity? R will be equal to, so divide it and convert it to percentage. What do we have? What do we have?
83%. 83%.
83%. 83%. 83%. Now, what about proportion of earnings retained? Yeah.
Hello, sir.
I can hear you.
Yeah, the retained earnings.
Yeah.
The retained earnings is 404,100.
Really? Oh, okay.
See,
Sorry. I put it as 4,100, Abby.
Yes, sir.
Sorry. 404,100. 404. Thank you. Let's correct that. Let us correct it.
Okay, so when you add it to
What's the difference first?
difference is 426,900.
426,900.
No. Okay, yeah. That
It
is
can't be 426 now.
no. Okay.
676,900.
No, I added the 50,000.
37 what? Okay, you added it. Okay.
676,900.
Okay, so the 2 will now be 426, Abby.
Yes, sir.
426,900. So what's the return?
12%.
12% is the return on equity. 12% is the return on equity. 12% is the return on equity. Okay. So proportion of earnings retained is equal to, that will be our retained earnings over profit after tax. We already have them here. These are retained. Where's our retained? We have it? No. Okay, we have it. Retained earnings over profit after tax will give you proportion of earnings retained. So retained earnings,
27,200.
profit after tax. So it's what?
27,200.
So you're writing G instead of B.
So 27,200 over 52,200, right? 52,200. That will give us what? That will give us what?
52%.
52%. 52%. So G is now equal to 12% times 52%. That will give us what?
That is 6.24%.
6.24%. That is our growth rate. So I'll now go and put it in that. I'll go and put it in that formula. Okay, by the way, what's our cost of equity? Are we given? Sure, we should. Sure. Cost of equity. Let's see. I think they gave us cost of equity down there. in the working notes. Yeah, cost of equity is 12%. Okay, shareholders of Congo Limited requires a minimum of 12% per annum from their invested investment in the company. So cost of equity is 12%. It's 12%. Therefore, I will have my value of equity to be equal to dividend, which is dividend is what, 50,000, Abi? 25,000. 25,000 into bracket 1 plus 0.0624 over cost of equity 0.12 minus 0.0624. So market value of equity will be equal to 25,000 into bracket 1.0624 over what? This minus this will give us what? What do we have? Are we there? Hello? Hello? Oh yeah, give me figure. Let's go now.
Hello, sir.
Yeah.
0.12 minus 0.06 will give us 0.0576.
0.0576. So, divide, multiply, divide. What do we have? Multiply this and divide it by this. What do we have?
What's
460.
460 069.
069. So market value per equity, market value per share is 460. Our number of shares is 50,000 over 50,000. So that will give us what? Market value per share. MPS.
$9.2.
9.2 per share. 9.2 naira per share. That is the market value of the share using dividend valuation model. Which is the next one? Let me remove this thing from me. The next one is using the price earnings ratio. Using the price earnings ratio. Using the price earnings ratio. That is 5. Using the price earnings ratio. So to use the price earnings ratio, market value of equity will be equal to PE ratio. I've given you the formula earlier. PE ratio times profit after tax. This will give you total value of equity. If it is MPS, we want to calculate it. The MPS is equal to price earnings ratio multiplied by EPS. So this one will give you per share. This one will give you total. Okay. So if you calculate your total, I want to get per share. Simply divide this by what? By number of shares. So there's no issue. So where's our price earnings ratio? Let's go there. and see what's our price earnings ratio. Look at it. We're told that the current price earnings ratio of Kampala is 12 times. Quoted company with similar activities and profitability have price earnings ratio of approximately 10 times, although these companies tend to be larger than Congo. Now, you will remember when I was discussing price earnings ratio as a method of valuation, I said only a quoted company will have a price earnings ratio. So if I want to value a company that is unquoted and I want to use price earnings ratio, I need to go and get a company that is already on the stock market and is in the same industry with that an unquoted company that I want to value. So you can see the situation here now. We're given quoted companies with similar activities and profitability. They have this, but we are told that although these companies tend to be larger than Congo, it means the significance of this statement here is that you should be aware that there will be inconsistency, inaccuracy, because this company is larger than Congo, but we still want to use the price earning ratio of that company. Now, to reduce the problem, you can, after your computation, you can tell the examiner that a smaller price earnings ratio may be more appropriate. For instance, reducing the price earnings ratio by 10% or by 20% may be better, because the company whose price earnings ratio you want to use is a quoted company that is larger than Congo. Okay, so I'm picking 10. I will pick my 10 price earnings ratio, market value of equity will be equal to our profit after tax is 52. Is what? 52,200. Yeah. 10 times 52,200. Okay. Value of equity is equal to 522,000. Is that correct? So my MPS, market price per share, will now be equal to 522,000 over number of shares, 50,000. That gives me what? What's happening today? If I are slow, what's wrong? Is it that you have calculated?
10.44.
10.44 per share. So you just put notes. The PE ratio may be reduced to account for difference in the size of Congo and the quoted company. Whose PE ratio has been used. So by that, we are done with that question. Any question before we go further? Have I explained the free cash flow?
No, sir.
Okay, so let's go to free cash flow. Let us go to free cash flow model. So we have learned the asset-based approach, dividend valuation model, what again? The price earnings ratio and others. So let's go to cash flow based valuation. So cash flow based valuation is the use of free cash flow model. Free cash flow model. So let's go and see that free cash flow. Now, what is free cash flow? Free cash flow is a cash flow that is not tied up to any obligation. The cash in the organization that is not tied to any obligation is what we call free cash flow. So when a company makes profit in a year, in a given year, and the company has computed its cash flow, that cash flow may not be free cash flow until it is adjusted to reflect all business obligations that need to be dealt with. For instance, in a year, a company may need to provide for working capital investment. You may need to pay for working capital. So if you need working capital, it means you need money to finance working capital. So if you need money to finance working capital, that money must be provided. So you remove it from the cash flow. When you have interest obligation, you pay interest. When you have debt obligation, you repay the due, the loan that has fallen due. And when you need to replace an aging asset, a non-current asset, you need to make provision for that. So after doing all this, the cash flow remaining in the business is what is called free cash flow, because that cash flow will be 100% free from any business commitment. That cash flow can be used at the discretion of management because it is not tied up to any obligation. And that is what free cash flow is in a simple language. Now, we have two types of free cash flow. Two types of what? Free cash flow. We have what we call free cash flow to firm. We have free cash flow to equity. We have free cash flow to firm. We have free cash flow to equity. Now, what is free cash flow to firm? A free cash flow to firm is that free cash flow that is available for distribution to both equity and debt holders. What does that mean? It simply means that when you compute your free cash flow and you have not settled debt obligations, it means inside that free cash flow, there is obligation to pay debt. So two sets of providers of finance can lay claim on that cash flow. And these are equity holders can claim part of it in form of dividend, and debt holder can claim part of it in form of interest payment and redemption of loan. So if you compute free cash flow before the settlement of interest and repayment of debt, that free cash flow is free cash flow to the firm. I don't know if you are getting this. Mrs. Chu, are you getting it? Hello? You can't hear me? Hello? Mrs.
Hello,
Joe?
sir.
Yeah. What happened?
I'm getting it, sir.
Okay. Now, how do we compute free cash flow to the firm? To compute free cash flow to firm, because the free cash flow we want to compute is for both equity and debt holders, it is also meant for both equity and debt holders. And that is what? Profit before interest and tax. True or false? Profit before interest and interest. So, because the cash flow I want to compute is the cash flow before the payment of interest, interest should be included in cash. We are starting with profit before interest and tax. Now, when you get your profit before interest and tax, you will go and deduct your tax. However, the tax you are going to deduct is not tax rate times profit after tax. Profit before tax. No. You are going to charge the tax on profit before interest and tax. Okay? Profit before interest and tax times tax rate is how you compute your tax when you are dealing with free cash flow to the firm, not profit before tax times tax rate. Please take note. If you don't understand, let me repeat it. Did you understand that? When you are computing your tax in free cash flow to the firm, your tax will be computed as profit before interest and tax times tax rate. You can see that it contradicts the normal tax treatment you know. Your normal tax treatment is such that you are multiplying profit before tax by the tax rate. In the computation of free cash flow to firm, it is not like that. We are going to multiply profit before interest and tax by tax rate. I believe that is clear enough. Okay. Now, all non-cash items, all items not involving movement of cash that were previously deducted, you will add it back. Those that were added, you will deduct. Because you are computing cash flow, no element of non-cash outflow, non-cash item must be included. And that's the reason why we are adding back depreciation and amortization. So, when you are done with that, you go and sort your working capital. This is the format you need to follow. You go and sort your working capital. You already know how to do that because we have done several of that. Okay? We've done several of that. So, after we have sorted your working capital, if it is an increase, you will deduct. If it is a decrease, you will add it. Then go and deduct capital expenditure. And that will give you your free cash flow to the firm. It is as simple as that. Please look at the format and ask your question before we continue. Very important. You must be able to know this formula because it's not the general way we say it will be provided in the formula sheet. No. You should know the formula. Okay, let us continue. What about free cash flow to equity? free cash flow to equity. The free cash flow to equity is the free cash flow after debt obligations have been settled. So my cash flow after settling all my debts is free cash flow to equity. Okay? And how do we compute free cash flow to equity? Now, in the computation of free cash flow to equity, our objective is to arrive at profit or cash flow that will be available to only equity holders. Therefore, we are starting with profit before tax normally. Normally, we are supposed to start with profit before tax, which is what? Which is this minus this. But if you are given profit before interest and tax, what's the procedure? Convert it, remove interest. When you remove it, then what will you have? You have profit before tax, then charge your tax normally. Okay, charge your tax, then you follow the procedure. Add back no cash item, less capital expenditure, less increase in working capital, add back reduction in working capital. Now, where there is proceed from the sales of debt, you will add it. Where you have redeemed some debt obligation, you will less it. What am I saying here? We have just three items. We have just three items that differentiate free cash flow to equity from free cash flow to fair. And these are they. They are the items I highlighted here. So these three items, they are the items that differentiate free cash flow to equity from free cash flow to fair. It therefore means that in the exam, where the question asks you compute free cash flow to fair, this element must be included. But where the question says compute free cash flow to equity, then you have to eliminate all these variables. Now, this will give you your what? Free cash flow to equity. That will give us free cash flow to equity. Any question on that? Please ask your question. Hello? Is everything fine? Okay. If everything is fine, let us continue. Now, ask you to compute market value of equity using free cash flow. Market value of equity using free cash flow. It simply means that you are discounting free cash flow to equity using cost of equity. Okay, you are discounting free cash flow to equity using cost of equity. That's what will give you market value of equity. But when you are discounting free cash flow to equity and debt, or let's go free cash flow to the firm, we want to use it to compute market value. The market value you are going to get is going to be corporate value. What is corporate value? Can someone answer that question? What is corporate value?
Value of the firm as well.
You said?
Value of the firm. Both the
What is the composition? What is the composition?
The debt and equity.
Okay. Market value of debt and equity is the market value of the firm. And that's what we call corporate value. So when you discount free cash flow to the firm using WACC, you get the market value of the firm. If you have the market value of the firm and you want to compute market value of equity, simply remove the market value of the debt from the corporate value. The balance is free cash flow to the firm, to equity. So let's take this question.
So can we solve this last
Which one?
question? I think
Let's
it's
finish this one
I think
first.
it's on this topic too.
After treating this topic, you should be able to solve that question.
Okay, let's see.
Yes, now.
Have you
That
seen
question
it?
you said?
You've seen the question?
Is it possible for me to see not to see a question in that for a subject I teach?
Ah, God. No.
Simplest question that you can solve within 20 minutes and get away. Don't worry. Let's continue first and see. I'm just hoping that we complete this. That's why I don't want to be taking additional question because of our time. But that does not mean that we cannot solve it anyway. Now let's look at the requirement of this question. I'm going to leave you to compute free cash flow for this question. Let's look at it. We read it together. I will explain what you need to do. Anyway, don't worry. We'll do it together. Now, required, calculate the free cash flow available to who? Calculate the free cash flow available to equity holders for the year ended October 21, 2016. B, use free cash flow to equity model to calculate the current value per share. These are the two requirements. Let us go through the question and see the content. Valuation Limited is a well-known company producing beverages for a variety of customers across Nigeria. In the last 3 years, because I'm now doing that, goes by listing shares. The directors are interested in determining a fair price per share of the company. Assume today is November 1, 2016. The following information has been extracted from the most recent audited financial statement of Valuation Limited. Statement of profit or loss, October 31, 2016, I think. Yeah. So our figures are in million. We have revenue, 15.7. We have cost of sales, 13.5. Earnings before interest and tax, depreciation, interest expense, earnings before tax, tax at 30%, profit after tax. So we have statement of financial position for 2015 and for 2016. We have cash and bank, account receivables, inventory, total assets, or total current asset rather, total asset, equity, and liabilities, non-current liabilities, which is bond, current liability, which is short-term loan, account payables. So we have our total current liability, we have our equity, and we have our total equity and liability. The following additional information is available. The directors believe that the free cash flow to equity model should provide an appropriate valuation for their company's share. An investment banker has provided the following estimate of cost of capital. Cost of equity is 15%. Post-tax cost of debt is 4%. And the WACC is 12.5%. The directors believe that free cash flow to equity will grow by 18% per annum for the next 5 years and by 5% thereafter. The company currently has 60 million in issue. So we have to calculate free cash flow to equity for the year ended 31st of October 2016, and to use the free cash flow to compute market value of equity. So let's go to our solution sheet. That's question 2, right? Adeosun. Adeosun Limited. Hello, can you hear me?
So we can hear you, but it's as if your screen is blank. I'm seeing a blue screen.
Hello?
Hello, okay.
What happened?
Your screen is back. It was blank for me. I don't know what happened.
Okay. Let us continue. Adeosun Limited. So first one is to compute free cash flow to equity. Mrs. Chu, are you there? Are you there, ma'am?
Yes, sir.
Okay. So we are working in million. Let me put this in million. In million. Okay. Now, because we are computing free cash flow to equity, which profit should I start with?
Profit before interest and tax.
Error. Profit after tax.
Sorry, after. No, profit after interest and tax, right?
Yes. Profit after tax.
What about the interest?
You have removed it now. Look at the formula I gave you. Let me show you. Oh, tired.
Yeah, profit. Sorry, sir.
Look at it. You can say, what did you do? What did I do? Profit before interest and tax, less interest.
Yes.
Can you see that? Less tax. The moment you remove your tax, you remove your interest, you remove your tax, what do you have left? Is it not profit after tax? It is when a credit can just give you profit before interest and tax. That's why I started with a profit before interest and tax. Ordinarily, when we are computing free cash flow to equity, you start with profit after tax. Do you understand?
Yes, sir.
Mrs. Chi, I want to confirm whether you are with us.
Yes, sir. Yes.
Okay. So, I don't like scrolling like this. Let me insert table. I prefer that table. It's easier for me than all this. Okay. So I put it this way. We work in millions. Work in millions. Work in millions. What's our profit after tax? What's our profit after tax? Do you have the question? No.
We have it, sir.
Eh? No, I mean.
We have it, sir.
Okay, so what's our profit after tax?
1054.
1054. Okay. So what do we do next? Add back non-cash item. Add back non-cash item. Free cash flow is not difficult to compute. Only that you need to understand the format. It is when you don't know the format that it becomes difficult. Once you know the format, it's very simple to compute. Okay. Now, what's our non-cash item? Basically, that is our depreciation, right? That's our depreciation. And what's our depreciation in this question? Let's go to our income statement. Depreciation is 440. 440, I add it back. $440. So not there. $440. Then you sort your working capital. What do we have as our working capital here? We have for our working capital, we have current assets. We have accounts.
Receivables. We have receivables.
Yeah, we have receivable and
Inventory.
inventory. Yeah, receivable and inventory. We allow me to copy you. Okay. Receivables. What do I need to do to this? I will go to the statement of financial position. I will compare my receivable for last year with my receivable for the current year. Last year, look at our receivable, 980. This year, what has happened to it? It has increased, have you? Hello?
Yes, sir.
So that's an increase in working capital. I should be deducted.
Okay.
So 10 let me go and check again. 1072980. 1072 minus 980. What is the difference?
92.
Eh? 42.
I know. Sorry. 1022 or 72.
92.
92.
Yes, sir.
Yes, that's correct. 92.
Yeah, I'm
Then
getting 42.
how did you get 42? You don't
10
get 42.
1022 minus 980.
1072. It's 1072, sir.
72.
7. I was
It's
saying.
1072, yeah. Sorry. So where is our inventory?
Inventory is
Inventory
254.
is 2078 2452.
2542.
Okay.
2542 minus 2078.
8 minus 2452. Have you?
Yes. 2542. 54.
2542. So what's the difference? Increase or decrease?
Increase.
If it is a decrease, you add.
Add.
If it is an increase, you deduct. That's the rule.
Is an
So
increase.
what do we have?
464.
Yeah,
Increase
464.
over what? 464. Increase of 464. Next item. I think we are done with
Okay,
we are done with okay, I think we have payable. Let me go and sort payable, sorry.
But you said if it is an increase, you said it's an
Deduct.
outflow.
You deduct.
You deduct. Okay,
Yes.
that means this ones now will deduct them.
Yes, now. When I post it to that column, you can see that I'm doing the calculation here. When I post it, I will deduct it.
Okay.
I'm just sorting all my working capital here. I will not put it as one figure. Do you understand?
Yes, sir. The payables.
Payable. Where's our payable?
We have 3084 and 2794.
Minus. Yes.
2792.
2792. Increase or decrease?
One is an increase. Right?
Increase in payables. So it is
We had.
is an inflow.
Exactly. When you have increase in payable, it's an inflow. When you have decrease in payable, it's an outflow. Just opposite to asset. You understand? Opposite to asset. So what do we have then? It's an increase, Abby. Because
Yes.
it's an increase, I'll just take away from this balance. So what do we have?
292.
292. I'll just move away from here. Let me create more table. More rows. Oh, but I know swimming. Okay, so which other one do we have? Nothing. Now look at it. This one is low. You can see short-term loan. So you can't treat it as working capital. It's a loan. Non-current liability. This one is long-term loan. The other one is short-term. So we have sorted all our working capital. That's what it means. Then we now go to, let's take this. What's the total of this? What's the total? What is the total?
264.
264.
Yes.
So you now deduct it. Because it's a net increase. It's a net increase in working capital. So it will now be deducted. And hello,
Yes, sir.
can you hear me?
Yes, sir.
Okay. So we have sorted all our working capital. We go and sort our issue of debt. So we compare the debt, short-term, these two here, short and long-term debt. So issue / redemption of debt. Issue / redemption of debt. Issue / redemption of debt. Bond. What is the opening balance of the bond? Opening balance of bond is 25. Closing is 24. So we have redeemed, Abby. 2,500 at the beginning. 2,400 at the end. So that will give us 100, 100, a decrease. So a decrease here. And for short-term loan, let's see what happened. 1432, 1936. 1432, 1936. 1432, 1936. What do we have there? What do we have? Oh, yeah. Eh?
504 minus 504. Sorry. Sorry, 504. Yeah.
So add this together. We have net of what? 404, abi? 404 net increase. Net increase. 404. 404.
So I do not understand this issue and redemption of debt.
Now,
Is it part of the formula?
yes, now. What has there? Look at it. In 2015, our debt is what? 25, abi? For bond. And in 2014, it has dropped to what?
Yeah. 24.
24, right?
Yes, sir.
Hello?
Yes,
So
sir.
what has happened? What has happened? We have repaid part of our loan obligation. So money has gone out.
Okay.
Do you understand?
Okay. Yes, sir.
Money has gone out. But for short-term loan, in 2015, it was 1432.
Okay.
Please, 1 minute. 1 minute, please. Let us continue. So for short-term loan, this is the value in 2015. But look at what has happened in 2016.
Increase.
It has increased, Abby.
Yes, sir. Now it's
So it
both
means we have taken additional short-term loan. We have collected more money. Did you understand?
Yes, sir.
So what is the net? We have net, okay, it's increase, sorry. Net increase in cash from debt is 404. This is what we raise during the year, and this is what we repay. So the net is 404. That's clear, Abby? Is that clear?
Yes, sir.
That's how to sort it. It's not difficult at all. Not difficult at all to sort. And the next one, which is capital expenditure, CapEx. Capital expenditure, we need to work this one out in form of work notes. We have to get work note for this. Working one. So my workings for CapEx. Mrs. Chiu, are you with us?
Yes, sir.
Okay, ma. Hope everything is still fine, Abby.
Capital expenditure.
Yes, sir.
Yeah. So for CapEx, you are comparing, look at it, this is what you are doing. You are comparing the non-current assets at the beginning of the year with the non-current asset at the end. We are comparing the figure for 2015 with the figure for 2016. But there is a problem here. You cannot just compare it the way you compare your account receivable and the inventory. Do you know the reason? The reason is that between 2015 and 2016, depreciation has occurred. True or false? we have charged depreciation
Mm.
of 440. So the two of them are no longer the same. What you need to do is you need to bring the two to the same base. You will get the closing figures here. The depreciation you charge for the year, add it back so that it will be the same figure as what you have before at the beginning of the year. Mafus.
Yes, sir.
Okay, sorry, guys. I just needed to go and play this stubborn boy. Go away. So what we need to do is that the non-current asset we have here, the one that you have at the beginning and the one that you have at the end, if there is addition, or sorry, if there is no addition, and you have not depreciated any asset, the two of them should be the same. Do you understand this? Let me explain again. You see that this is the balance at the beginning, Abby?
Mm-hmm.
This is the balance at the beginning. And this is the balance at the end. If there were no depreciation and no addition to fixed assets, the two of them should be the same. What you have at the beginning and what you have at the end should be the same.
Mm.
So what will make them not to be the same is depreciation and what?
Additional assets.
And if so if you have not depreciated the assets and you have not bought additional assets, the two figures here should be the same. So the first thing that we need to do is I will first go and add back my depreciation here because I've deducted it, Abby. I will add my depreciation to it. I will now look for the difference. The difference is what I bought during the year. The difference is what will make the two not to be equal. Do you understand?
Yes, sir.
Eh?
After adding back depreciation.
Yes. After you added back depreciation, normally the moment you add back depreciation here, what you will get should be equal to this one. Do you understand? So what will make it not to be equal to this one is the addition to non-current asset during that year. So the approach is closing balance of non-current assets, closing balance, which is closing balance, which is 6224, 6224 plus depreciation. Plus depreciation. What's our depreciation? 440. The one we added back here is 440, if I'm not mistaken.
Yes, sir.
Yes, 440. I've seen it. 440. So when you add this, what do we have? 664. 6664, I mean. 36. If you have
364.
yes.
664.
6. Are you tired like myself? Eh?
I'm tired. Before the class, I've been tired.
Eh?
Before the class started, I've been tired. Just
I
one.
hear you. Now you can see now. You know, the moment I added back depreciation, Abby, I'm supposed to have this figure. I'm supposed to have this figure here. Where is that?
The opening
This is what I'm
price.
supposed to have.
Mm.
You can see that they are not equal. We still. I wanted to make them equal. So the denominator deducted there, I added it back. But still, it is not equal.
Yes, sir.
They are not equal. Difference is the asset I bought during the year. So I will remove opening balance. That's the way. Opening balance. What is the opening balance? 5442, Abby. 5942. 5942. 5942. 5942. So, what is our capital expenditure there? Addition.
722.
So, what is the difference?
722.
722. Hello?
Yes, sir. 722. 722.
So, that is the value of non-current asset that we bought during the year. I believe you know how to sort it, Nabi.
Yes, sir.
722. So we go and add the 7, we go and deduct the 70 because we bought it. So it's 722. 722. So by that, you are done with free cash flow to equity. You have sorted all that needed to be sorted. So what is our free cash flow to equity? Go and give me the figure now. Free cash flow to equity. Is what? Yes, now it's an expenditure now. Money has gone out. It's an expenditure. Outward movement of cash. Do you understand? Hello?
Yes, sir.
So what do we have?
$912. 912.
912. That's the free cash flow. Free cash flow to equity. I'm coming. Come on, sit down. So any question on this? Do you have any question here?
No questions, sir. Fine.
Okay, let's go to requirement B. Requirement B. What can we also do there? The question asks us to use free cash flow to equity model. We also use free cash flow to equity model to calculate the value per share. Abi? Current value per share, yes. Now, I'm going to solve this question in 2 ways. I will solve one way today. So in our next class, I will solve the second one before we go to the next question because of time. Okay?
Okay.
Market value per share. Market value per share. When you discount free cash flow to equity, using cost of equity, you get market value of the company share. When you discount free cash flow to equity, using cost of equity, you get market value of equity. So I already have free cash flow for this for current year. This is my current free cash flow. And I have been told in this question that free cash flow is expected to grow at what? Free cash flow is expected to grow at 80% for 5 years. And by 18% for the next 5 years, and what? 5% thereafter. So what will I do? I will pick the current free cash flow to equity. I will grow it for the next one. This is the current one. This one represents year 0 free cash flow, please, because it's the current year free cash flow. I told you that whenever we are making a valuation, we are using future cash flow. Always remember that principle. Anytime you are making a valuation, you are using free cash flow, you are using future cash flow. So, since this is year 0 cash flow, I cannot use it. I will have to predict cash flow for the future. And that's the reason why the question gave us 18% for the next 5 years and what? And
5% thereafter.
And 5% thereafter. Yeah, take. Don't disturb me.
So,
Yes, I can hear you.
So I'm trying to put down what you said there. Like you said, when we are discounting free cash flow to equity, we will use
I said, no, that's not what I said. When we are computing market value, not only free cash flow to equity,
okay.
When we are computing market value, do you understand me?
Yeah.
The cash flow that you need should be future cash flow. Look at this information here. The information we have here, is it future information? This profit or loss? Wait. This profit or loss account, is it for the future or current?
Current.
So it's year 0. Anything that is current is year 0.
Do
you understand?
Yeah, I understand. The question I'm asking is, you said earlier that when we want to discount free cash flow to equity, we will use some
cost of equity.
Okay. All right.
You use cost of equity. If you want to discount free cash flow to firm, you use WACC.
Okay.
You must understand the principle of appropriate WACC. If I'm discounting free cash flow to equity, free cash flow is only for equity holders. So I need cost of capital that is only meant for equity holders. And that is cost of equity. But if I'm discounting free cash flow to the firm, free cash flow to the firm is meant for both equity and debt holders. So I need cost of capital that is meant for both equity and debt holders. And that is WACC. Do you understand?
Yes, sir.
Okay. So what I'm going to do here is that I will have my year. Yeah, 1, 2, 3, 4, 5. Okay. So I have my year. You now have year 0. This is not MPV. Eh? This is not MPV, please. Nothing like year 0. I think that I need to add another one, because after the 5th year, free cash flow will not be growing by what? Will not be growing at 5%. So I will have year 6 to infinity. I have year 6 to infinity. Year 6 to infinity. So for year 1 to 5, my free cash flow to equity is going to be 912, which is the current free cash flow to equity, times 1.18 raised to power n. Raised to power n. Okay. So let's get our value. Year one will be what? Year one will be what? Let me do it myself. Okay. I was thinking that this way has taken
Year
my
one
time.
is 1076.
1076. Year two. Just be multiplying it by 1.18. 1.18.
Excuse me, sir.
Yeah.
I thought you are going to use annuity.
I said I'm going to teach you two ways. This is the simplest way.
Ah,
That's why I said I'm going to teach you two. Let's use this one. Tomorrow we explain the second one.
It's need to go. 1270. Yeah, 3 and 1.18. 1498. Yeah, 4 and 1.18. 1768. Yeah, can you continue? 2086.
Okay, sorry for disconnection. Let's quickly approach this question, please. So what's the year two figure?
1270.
1270. Year three.
1498.
1498. Year four.
1768.
1768.
68.
Year five.
2086.
2086.
Yeah.
Okay, now, how do you get year 4, year 6 to infinity. Year 6 to infinity will be referred to as terminal value. Terminal value. So we have to go and calculate the terminal value. So let me call this workload 2. Terminal value. So 2. Our terminal value will be computed as terminal value is equal to free cash flow to equity in year 5 into bracket 1 plus G all over cost of equity minus G. This is perpetuity with growth, which we have already discussed. Investment is a perpetuity with growth. So terminal will be equal to what's our free cash flow year 5? 2086. So you bring down the 2086. What is the growth rate after the 50th? 5%. 1 plus 0.05 all over what's our cost of capital? 10%. That is our cost of equity. Cost of equity 0.1 minus, am I correct? 0.1. Let me double check, please. Can you imagine? It's 15% too. I've made that mistake. It's 0.15 minus 0.05. So my terminal value will be equal to 2086 into bracket 1.05 close bracket over 0.1. Oh yeah, multiply and divide. Give me the figure. That's what you need to put here. That's what I'm going to put here. Hello?
Yes, sir.
Where bring the phone. Bring it.
21903.
21903. 903. That's the terminal value. That is the terminal value. That's the terminal value. So you will now discount this. Discount factor at 15%. Discount factor at 15%. What's 15% year 1? What's 15% year 1?
0.87.
3 decimal places, please.
0.70.
0.7. 3 decimal places.
0.870. Sorry, 0.869. Sorry.
Year 2.
Sorry, could it be 0.870?
Year 3.
I know. Year 2 again.
Is it 2? Are you there?
Year 2
That
is
of your wife, if you
0.907.
approximate.
What do you say?
That of your wife, you approximate, it will be 0.870.
Year 1.
Yeah.
Year 1.
Yes,
I said
sir.
3 decimal.
Yes, there's approximation figure there.
So year 3 will be what?
No, yeah,
Year 2 is
0.56, 0.756.
Year 2, 0.907.
No,
How can this one be 0.8? This one will be 0.9. It's not possible now.
this one 0.756 for year 2.
Okay, year 3. Yeah, 3.
5, 6.
0.658.
0.658.
658.
Yeah, 4.
0.572.
572, Abby.
Yes, sir.
Yeah, 5.
0.497.
497. Now, you will repeat the discount factor of year 5. You will repeat it in year 6. That's what we call discount factor of the base year. What is the base year? The base year is the year whose cash flow you use to generate this cash flow. We use 2086 to compute our terminal value, right?
Yes, sir.
And terminal value is what? It's a year 5 cash, sorry, 2086 is year 5 cash flow. So my year 5 is the base year. That is the discount factor I'm going to repeat here, 0.497. That's what, when I say discount factor of the base year, that's what I mean. Because I have to use this figure to compute this figure here. So my base year is year 5. So what is our present value? PV. Let us multiply. This is the simplest approach that will not stress you at all.
Out of time.
But I'm going to solve an tomorrow. So year 1 will be what? We are multiply. Oh. Multiply, give me the answer. Oh. I will leave you to go and complete it too.
Okay, year 1.
Yes. What's year 1?
935.
935.04.
0.044.
Let me just use 935 approximately.
Okay. 960. Year 2.
960.
Yes.
Okay. 960 year 2. Year 3.
986.
986. Year 4.
1011.
1011. Year 5.
1037.
1037. And year 6 to infinity. Year 6 to infinity is what?
10885. 10885.
That's the one.
886. This year I'm going to school tomorrow. Your value is
So what do we have? The last one.
10,886. 10886.
10,886. So what's our total market? Add everything together. That's the total market value of equity. Total value of equity. Add everything together. Remember, this one is short. You will see that I'm going to do tomorrow. You see how lengthy it will be. That is when you will appreciate what I did today. For now, you not appreciate it. When we do annuity tomorrow, you appreciate this one. So what is the total?
15,815.
15.
15,815.
So what's the market price per share? Are we given number of shares? Let me see.
Share in the table.
Okay, we are not given number of shares, so we can't calculate number. We are not given number of shares.
They gave us number of shares.
Oh, God, I think it's there.
Where?
They said the company has company currently has 600 million shares.
Oh, okay. That's true. Yeah. So this one now will now be equal to 15,815 over 600. That will give us what?
26.336.
80.
26.36.
26.36 per share. That is how to use free cash flow to equity to compute market value of equity. If, assuming what we have here is free cash flow to firm, I will have used what? I will have used WACC instead of cost of equity. And that will have given me corporate value. Do you understand? I would have gotten corporate value, which is total market value of the company as a whole. That's what I would have gotten there. So I can only use WACC to discount if I'm computing corporate value. If the cash flow I have is free cash flow to firm, for me to discount, I must use WACC. If you go and use cost of equity to discount free cash flow to firm, you are not doing the right thing at all, because the two do not match. Are we fine? Are we fine?
Yes, sir.
All right. Any question before we call it a day? Any question? No question, right? Mr. Shikwe, question?
For now, no questions, sir.
All right. Thank you. We'll meet tomorrow by God's grace.
What time,
Tomorrow, what time, sir?
I can't say for now, but we'll meet tomorrow. I will communicate.
sir? I have a program. I don't know.
What is your program?
I need to plan.
Eh?
My program starts 12 o'clock.
12 to when?
Maybe 3.
It will be, if I was going to meet. Eh?
Can we have it like the same time like this?
Yes, highly possible. Even though if I go to meet, it's going to be from 4 upward. It can't be earlier than 4.
Fine.
So you'll have finished your program there.
Yes, sir.
And bring a rice to the platform.
Virtual rice. Okay, sir.
All right.
All right.
Have a wonderful night rest.
I need to, sir.
Okay, we'll be waiting for you tomorrow.
No problem.
Thank you, sir.
You're welcome.